Peloton and Nike are well-known companies to people that like to exercise, but investors would be curious to hear the conclusion of which one makes a better stock to buy given their current market prices. So in this video, I'll compare Peloton and Nike on critically important financial metrics, including revenue, profit margin, and return on invested capital. I'll also compare them on valuation, measuring on a discounted cash flow valuation model I created to determine what the fair value is and compare it to the current market price. And then I'll also show you the forward price to cash flow numbers for these two companies. I'll do all of that in this short video, so let's get right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the first thing I wanted to compare these two is on revenue growth, and they've both faced challenges. Looking back longer term, however, they both managed to increase revenue. Nike has grown its revenue from 36.4 billion to 46.3 billion. That's good for a compounded annual growth rate of just 3.8%. That's the slowest rate of revenue growth for Nike going back any previous 10-year period. Nike's growth rate has been challenged, and that led to the CEO being changed, new CEO coming in trying to turn things around, but the most recent quarter was yet another quarter of revenue decrease. However, the CEO gave such an optimistic view into the future that investors bid up Nike stock despite the turnaround not yet happening in terms of top-line growth for Nike. Peloton, meanwhile, is further along in its turnaround. The company made some dramatic errors during the pandemic that it took years to fix. Still, demand for its products is really, really strong compared to where it was in 2018, when it just generated 400 million in revenue. That's grown to 2.5 billion in revenue. So it's below the peak of 2021 of 4 billion, and it's now down to 2.5 billion. The company invested too much in manufacturing when they were experiencing a surge in demand during the pandemic, when people were locked down at home and gyms were closed. You might argue that management should have known better. Well, I would agree with you. However, hindsight is 2020. The management team that made the decisions, that made those huge mistakes, are no longer in place. There's a new leadership team now, and they're turning things around, as I'm going to share with you here. Peloton, as I mentioned, made some huge errors during the pandemic, and their profitability crashed when gyms reopened and sales fell. Their operating margins to cash flow fell to 56% negative and has since recovered to 13.4% positive. As I mentioned, the newer leadership teams that came in to replace the management teams that made those mistakes have managed to turn things around. And in fact, Peloton's cash flow to sales ratio is much better than that of Nike now, as Nike has been on a downtrend itself, falling to 8% OCF to sales ratio, down from 11.4% in 2018. Nike sales are falling by double digits. Nike's impacted by the increase in trade barriers. It's going to have to pay higher cost of goods sold for its manufactured products overseas. So will Peloton to some degree, but Nike perhaps more so than Peloton, because Peloton has a robust services subscription segment that generates strong profit margins. Even if it doesn't sell any new bikes, that subscription business can do relatively well as long as they can keep the churn rates low for the foreseeable future. The next metric I wanted to compare these two on is the return on invested capital. And again, Peloton demonstrating great improvement, rebounding to 7.1% from negative 62%. Nike, meanwhile, heading in the wrong direction, but better number than Peloton at 15.2%, down from 36.5% in 2021. So now that we looked at some of the important financial metrics, let's look at valuation. And I updated these valuation models today, where I calculate a fair value of these stocks. And Peloton's intrinsic value per share increased to $10.62 compared to the current market price of $7.58. Even after I apply a margin of safety, this stock looks undervalued. Now, when I calculated a similar fair value For Nike, I found this business to be overvalued with the current market price of $73 and an intrinsic value of $55. By the way, these charts that you're seeing, I'm getting from fiscal.ai. They are my preferred data provider, and there's a link in the description for their services if you're interested. Now, when I measured these two businesses on a forward price to cash flow basis, Nike stock also looks significantly more expensive compared to Peloton. Is trading at a forward price to OCF of 34 compared to Peloton, which is trading at a forward price to OCF of 12.73. So comparing these two across these important financial metrics and then looking at valuation, I didn't see anything that showed Nike deserves this much of a premium valuation against Peloton. Nike's brand power is perhaps the most significant advantage against Peloton, and that does deserve a premium valuation against Peloton. But the premiums I'm noticing are overdone, and I think investors are giving Nike too much credit for a turnaround that hasn't happened yet, while Peloton's turnaround is well underway and the business is improving. So if I had to pick between these two today, I would pick Peloton as the better stock to buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.